Good morning and welcome everyone to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Action-packed day yesterday with the ECB and BOE meetings. Both central banks raised their benchmark interest rates by 50 basis each. The ECB chief Lagarde sounded hawkish with even suggesting that another 50 basis hike is on the cards, while BOE chief Andrew Bailey showcased concerns of a fall in labor supply and productivity. JK, I won't take much time. Please take us through these developments and how you're reading both the statements.
Hey, good morning. Yeah, they did sound hawkish. Yes, but something very striking happened in the global markets yesterday, a day when two more central banks announced the hefty rate hike of 0.5%. Market had gone into the event in a hawkish mood, as had been telegraphed by central bankers for several weeks, particularly the ECB. But what transpired was that despite ECB even confirming there will be another 0.5 hike in March, and Bank of England chief saying that their fight with inflation was not over, markets behaved as if they had announced a rate cut. UK 10-year yield slumped by over 30 BPs and German bonds by 23 BPs. And in particular, the hawkishly packaged ECB rate hike with Lagarde saying keeping interest rates at a restrictive level will over time reduce inflation, dampening demand, and will also guard against the risk of persistent upward shift in inflation expectation seemed to fall on deaf ears as there was a massive buying in the bonds with terminal rate expectation now shifting away from 3.5 to 3.25%. And the German OIS actually overnight index swaps showing a big slump as well. On the other hand, George Bailey said that inflation might have seen its peak. So both after the Fed decision and the European counterparts yesterday, markets have taken a strong dovish view on rates and a striking optimism on rate cuts. The markets are betting heavily that central bank tightening cycles will end sooner than expected, with a plethora of comments from money managers straight to that point. The behavior of markets are as if the central banks have flashed a mission accomplished banner. The market thinks that if Fed stops tightening early, so will the rest of the central banks. What could have also triggered this is Bailey saying that, if the economy evolves in line with central bank forecast, we will need re-evaluate on the rate hikes. And also Lagarde said, we intend to raise rates by another 50 basis points in March, but we will then evaluate the subsequent part of our monetary policy. So markets have actually pared back expectations of both the central bank and, in fact, in BOE, with a chance of 79% of chance of a 25 BP hike in March and a peak rate of 4.28%, along with 31 BPs worth of cuts in half to 23. So that's a big shift in the market's perception on inflation as well as the rate path. So in the process, we have seen the yield difference between Europe, UK, and the US reverse strongly in favor of the US, resulting in traders selling off both pound and the euro. These reactions have clearly demonstrated the positioning of the market heavily long in currencies and extremely under-owning the major sovereign bonds. US yields did not, of course, fall much on the day, having already fallen post-Fed meeting. Even as the data yesterday came better, weekly jobless claims improved to 183,000 versus 186,000 the previous week, while expectation was for a number of 2 lakhs. And factory orders were much improved at 1.8%. Versus minus 1.9% last month, though expectation was for a 2.2% number. So we step into Friday's calendar with main focus on monthly jobs data in US, where non-farm payroll is expected at 190,000 from a previous month's 220,000, with more attention on wage inflation, which is expected to remain at 0.3% month on month, but year on year is expected to drop from 4.6% to 4.3%. We'll also have the updated surveys on services sector activities across the regions, which has been in contraction territory in most countries. But US is expected to bounce above 50 on the services PMI in this month. Markets in their current mood are likely to see the bad news as even better news for the rates, taking cues from the refreshed views of investors on rates. Equity markets were strongly positive, with both NASDAQ and S&P closing at 5-month highs. Tech-heavy Nasdaq, which moves directly in line with the interest rates, gained a staggering 3.5%, taking its total gain from October lows to 20%. Share buyback announcement by Meta, popularly identified with Facebook, aided the hefty gains in Nasdaq as well. And the global composite index of equities also rose by more than 1%. Dollar index, after hitting a new low at 100.79, recording a drop of 12.2% from the highs, saw a good bounce, even as good profit taking as emerged in euro and GBP, and later spread to other currencies like Australian dollar and even gold, for example. While it is too early to conclude, since we have bounced from a strong technical level, big level on the weeklies at 1.0045 for the euro, I tend to view this as start of a good correction. We have broken near-term support at 1.0930 and sustained it overnight for the euro and 1.23 for the GBP, with next levels to cross being at 1.0860 and 1.21. Yen remains relatively strong as we are seeing a good profit taking on yen crosses. And let's remember that while these major central banks, which I have mentioned, are close to the peak in rates, perhaps the policy in yen is just now shifting towards the upside. So that's the reason why yen remains so strong. Coming back to our own rupee, its performance in recent sessions has been stark. Underperformance has been stark, with the dollar index steadily hitting new cycle lows. While DXY hit 100.80, nearly 13% low from its high, rupee's divergence from it was at its widest as it traded just 1% above the all-time lows. INR also hit its multi-year low against major mini and EM currencies yesterday. The recent stock market turmoil and very large outflows witnessed from FPIs have triggered the recent weakness in the rupee. It continued in yesterday's trading, even though stocks attempted another good bounce. We are cautious that this divergence is too extreme to sustain, and the market will start to look beyond the current negativity in the markets. A good cue is the renewed interest we have seen in Indian bonds from foreigners, where we have received an inflow of nearly 1 billion in 2023. We look to see whether this interest sustains, as Indian bonds are better off seeing a better valuation, with inflation peaking and RBI unlikely to hike more than 0.25% from now on. The global investor shift back into fixed income investment this year may just favor the Indian bonds too, which are actually trading at 4-year high in the yields. Technically, we have a strong resistance for the rupee at 80 to 40, which is likely to hold near term. So everything boils down to whether we get the inflows for the Indian rupee. Thank you. Have a nice weekend.
Thank you, Suki. And one of the first statements you had mentioned in the beginning, that despite a hawkish ECB and BOE, markets rallied as if there was a rate cut. That was really fascinating. And despite all these interest rate hikes, something we would think as a common sense that if central banks are raising rates, there wouldn't be a rally in equities. It's all proved wrong. So basically, BOE chief Bailey said inflation might have seen its peak, while markets are even perceiving rate cuts in the second half of the year. I think the major theme which I can read out is that which central bank will outdove the other is what I think the markets are perceiving. From the Indian rupee perspective, it continues to be weak against the dollar, and as the world shifts in favor of fixed income, Indian bonds might become more attractive. That's it from us today. Thank you so much for listening. Have a very good weekend.